Today we're going to resume with Chapter 1, and we're going to look at the second learning objective, or the second module. In this module, we're going to cover the organizations and the rules that govern financial accounting, the standards that are used for external reporting, which again is the focus of the course. Along with the organizations and the rules that govern accounting, we're also going to spend some time looking at parts of the conceptual framework. That's the underlying theory, the underlying assumptions and principles that are used to develop accounting standards. In the United States, the two primary standard-setting bodies are the Financial Accounting Standards Board and the Securities and Exchange Commission, or the SEC. The FASB, or the Financial Accounting Standards Board, was initiated in 1973, and we'll look at some other of the standard-setting bodies. It's not the first standard-setting body in the United States. We've had several, and they change as we'll discuss. The FASB is not a government agency. It is privately funded. The Financial Accounting Foundation will collect contributions from sponsor corporations. So it's privately funded. And they create the rules and the standards that govern financial accounting for external reporting. And their rules apply to all companies, whether public or private. In other words, are your securities traded on an exchange, such as the New York Stock Exchange? If the answer is no, it's a privately held company. A family and limited investors hold the shares of stock of that entity. If it's publicly traded, the shares are traded on an established or an organized exchange, such as the New York Stock Exchange. That's where the SEC comes in. The Securities and Exchange Commission not only is involved with the standard setting process, but they oversee U.S. financial markets, and they govern the accounting and, of course, the regulations for issuing securities for publicly traded companies. Now, their standards are very similar, but you're going to find out that the SEC involves much more disclosure. Now, historically, accounting standards were inconsistent. And before the market crash in 1929, there were some companies that would give you just information about their assets and their liabilities, or perhaps a balance sheet. Others would give you information about their earnings, about their sales and their expenses, or their net income or net income or net loss. So, as you can see, the information that was provided to the users of financial statements was incomplete and inconsistent between companies, and probably even inconsistent year to year as companies were issuing financial statements. Made it very difficult to compare, and it wasn't very useful. So you couldn't compare a company over time, or you couldn't compare two companies in the same industry. So the stock market crash was the driver for the government to now regulate securities and regulate accounting. Prior to 1934, there was really no established governmental agency for overseeing the financial reporting of companies that were publicly traded. Now, although the Securities and Exchange Commission has the ultimate authority to dictate standard in the United States, or to develop accounting standards in the United States, they decided that it would be best if the private sector, CPAs, and other organizations were responsible for the development of accounting standards. So they delegated that job, the standard setting responsibility, to the accounting profession. Now, the SEC still issues standards and does have veto power over the standards issued by the Financial Accounting Standards Board. Now, as we'll see later on, there were multiple bodies over time that issued accounting standards, which are known as generally accepted accounting principles. Now, the SEC requires that publicly traded companies issue an annual report, and as we mentioned, the annual report has to be audited by an independent CPA. We covered some of the independence issues in the first module. The annual report is known as the Form 10-K, so that's the annual. Quarterly reports, which are very important information, are called a 10Q. 10Q, by the way, are not audited, so that's something that's important. And again, I keep emphasizing the fact that you are not all going to be accounting majors, but you're all going to use accounting information at some point. So this is important. So this is not audited. And it says that right on the 10Q itself, so you sort of have to let the buyer beware. You know that a lot of the information in the 10Q may be estimated, and it may not be the final numbers. Now, the SEC does establish accounting standards on its own. However, they work closely with the Financial Accounting Standards Board. Now, the Financial Accounting Standards Board is, as we said, since 1973, is the board that is responsible for setting accounting standards in the United States. And that board issued standards from, again, 1973 to today. They used to issue what were known as statements, but as we'll see in a moment, that is now part of what we call the codification, the accounting standards codification. The board is independent. You could come from industry. You could be an accountant. You don't have to be a CPA. You could be from the government or education. These are full-time members, and hundreds of staff work on accounting standards that will respond to existing business transactions and, in addition, determine the best way of accounting and reporting for existing and perhaps new business transactions as they are developed. You know, you have to think about the widespread use of leasing in the United States took place maybe 30 years ago. How do we respond to that new form of financing? You know, how many of you, probably almost everybody that's in this course is going to know someone, if it's not you, but someone that leases a vehicle. You know, somewhere around 50 years ago, leasing of automobiles was not common. And in fact, it probably didn't exist in the United States. It might have existed in other parts of the world. So once leasing became predominant, how do we respond to that? In addition, today we now have the need to think about various types of financial instruments. As new financial instruments are developed, hedge funds have become a very, very big part of our economy. How do we account for those types of entities? In addition, we are involved with international standards. The International Accounting Standards Board and the FASB are working closely together in order to converge, meaning to have standards that are nearly identical worldwide. The reason for this is the expansion of global business. If a company from the United States wants to issue securities in Europe or in Asia, they have to have statements that could be interpreted and read properly by the individuals analyzing that company's financial statements in those other countries. Similarly, an international company may want to trade in the United States, may want to trade on the New York Stock Exchange, and as a result, they will need to be able to produce financial statements that could be understood, properly analyzed by a U.S. analyst. By having standards that are converged or similar or identical, if that's the ideal, if that is possible, that would make the analysis very clean and very easy as you move from one country to another. Now, the dates here are perhaps somewhat optimistic, but we are moving towards convergence almost every day as new standards are developed. Now, when we think about these standards, we mentioned the term generally accepted accounting principles, and at this point in the course, the most important thing for everyone to remember is that generally accepted accounting principles are not rules in the sense of mathematical rules or theorems. They are, in fact, nothing more than broad reporting guidelines that represent the best alternative or alternative methods selected from many possible alternatives. And as we said, the FASB and the Securities and Exchange Commission and the International Accounting Standards Board currently work on standards to adopt or to address new or existing business transactions. What is the best way to account for a new or an existing business transaction? Is it optimal? Do we need to revise that? So they are changing and they're flexible. I think the key right here is the idea that there are alternative methods selected from many possible alternative methods. Some of these methods could increase income, and some of them can reduce income. There are differences in the valuation of assets and differences in the valuation of liabilities. So the way we measure a business transaction will affect a company's income, and it will affect a company's asset and liability valuation. Now, the best analogy I can give you is if you're watching a ball game, let's say from Yankee Stadium, and you look down the right field line, the distance is about 300 feet. If we were playing in a country using the metric system, the distance would be, let's say, roughly 91 meters. It's the same distance, but it's measured using a different measurement system. And that's what different accounting methods are. They're nothing more than different measurement systems used to measure the same economic event. The most important thing, particularly those of you that will be dealing in finance or management, most important thing to remember is that the transaction is not changed. It's simply the way the transaction is measured. By understanding accounting and knowing how the transaction was measured, you have a very good idea, maybe not dollar for dollar, or maybe you can't really convert. I don't know the metric system, but when I see a game in Toronto and I see the right field line says 91 meters, I have an idea it's about 300 feet. So it's the same notion in accounting. If one accounting method is used by one company and you're comparing it to another, you'll at least know that company A is using the income increasing approach and company B is using the income decreasing approach. And that will enable you to gauge the potential direction of the numbers when you analyze those statements. Now, even though GAAP has such flexibility, even though GAAP can change over time, and it changes from country to country, it doesn't mean that you should not have confidence in the numbers that are reported under GAAP. GAAP enhances user confidence in published financial statements because, at a minimum, you know that the statements were prepared under a uniform and an approved set of accounting standards at this time. It helps satisfy the most important and the primary objective of external reporting or financial accounting, and that is to provide information that enables users to make rational economic decisions. Credit decisions, lending, banks, investment decisions, buying the stock as an investor. So information needs to be useful. Now, that useful information, as we said, right now comes from not only SEC, but from the Financial Accounting Standards Board. And as I said, it was formed in 1973 and it's still in existence. And of course, these are the rules for recording, measuring transactions, and reporting them into financial statements. Right now, I mentioned the FASB used to issue what were known as statements. You know, now everything is in this codification, which you can get access to. You can get access to that. Bring that back. You can gain access to that codification. ASU, Accounting Standards Codification, and all the standards are there. Whether sometimes you'll find references in our textbook as well. And as part of that codification, the information that's there must be useful. In other words, it has to enable the user to make rational economic decisions. Now, what does it mean to be useful? Well, the two primary qualities of useful information are relevance and faithful representation. These are the primary qualities of useful information. Now, what we're about to look at is a part of what we would consider to be the conceptual framework. As we said, the conceptual framework underlies information that is reported and the standards that are used to govern that reported information. So, in order to be useful, the qualities that information must have are relevance, and it must also have faithful representation. What is relevant? Relevance means that the information allows the users to make a rational economic decision, and that information must possess the following qualities. It must be material, and we said that materiality means significance. It means that the information is significant enough to influence the judgment of a reasonably informed financial statement user. It must also have predictive value. In other words, you're using financial statements to decide whether or not to extend credit to a company. The predictive value that you're looking for is the ability to assess whether or not the borrowing company, the debtor, the borrower, has the ability to repay this debt over the next 15 years. You have a mortgage, 15 years, a car loan, 3 years. Do you have the capacity to pay that loan and the interest? That's the predictive value. And finally, in order to be useful, has to be relevant, and relevance has to have confirmatory, or the information has to have confirmatory value. So if you were trying to forecast earnings for a company, you use past information to make predictions, but when the actual information 5 years from now is released, you confirm that projection. Did you over or underestimate? The second primary quality of useful information is faithful representation. That information to faithfully represent the underlying economic substance of the transaction. That's exactly what it means. Accounting information, to be useful, must faithfully represent the underlying economic event that you're trying to measure. And in order to do that, the information has to be complete. It cannot omit any significant information. It has to be neutral, that is free from bias. Neutrality is a very important quality. In other words, we would not want the company to try to portray a picture that is either overly optimistic or overly pessimistic for whatever reason the manager may want to raise earnings. And it has to be free from, again, material error, going back to our first module where we said that it is not the idea that the statements are presenting accurately or 100% accurate, but they are going to present fairly. And a fair presentation means free from material error. Now, the use of GAAP helps ensure that information is useful. And as we said, GAAP here that we're looking at is part of the conceptual framework. Now, again, we said that a lot of people may look at GAAP and say, well, why should I have confidence? It constantly changes. And we know that it does because it responds quickly to its environment. And GAAP changed over time. As we said, right now, the FASB has been around since 1973. Prior to that, we had two predecessor boards. We had the Committee on Accounting Procedure, and they began in 1934, right after the Securities and Exchange Act. This is where the SEC decided that the private sector should handle, or they delegated the responsibility for issuing accounting standards to the private sector. And the Committee on Accounting Procedure was in place, and their objective or their goal was to limit the number of alternatives that we use in practice to try to get consistent reporting, so everyone should show net income or net loss. Everyone should show a balance sheet with their assets, liabilities, and equity. So they wanted to get consistency and some conformity, and they did want to limit the number of alternatives that companies could possibly use to measure the accounting transaction. So before, as I mentioned, you're looking at distance. Well, maybe there's a third measure. Maybe there's aside from 91 meters and 300 feet, maybe there are other ways to measure that distance. And in fact, you could probably even measure it in inches if you wanted to. But the Committee on Accounting Procedure, now applying this in accounting, said, look, there's 3 or 4 ways to do it. We're only going to allow 2. So they limited the number of alternatives. Once they met that goal, then they set up the Accounting Principles Board, and they lasted right before the FASB came in. And their goal was to address existing and emerging issues. Now, they moved very slowly, and that was because all of their members were part-time. All of their members were affiliated with large CPA firms, and that also gave perhaps an appearance of not being independent. In other words, someone might say, well, I am trying to, if I'm on the board, they might say that I'm trying to vote for a standard that would make my client's income look better or make their financial position look more favorable. So that was one of the reasons why the APB was disbanded. The other reason, again, they just moved very, very slowly because everyone here was part-time. Now, of course, we said that the FASB came into play in 1973. Now, what about the rest of this conceptual framework? Aside from being relevant and faithfully representing the underlying economic substance of the transaction, what are the other parts of this conceptual framework? Well, we've got a great deal of concept in accounting, and we sometimes call them assumptions, principles, concepts, and the 4 we want to look at now are the business or economic entity assumption, the monetary unit assumption, the cost principle, and the going concern assumption. Under the economic entity assumption, sometimes called the business entity assumption, a business is a separate economic unit. It must be kept separate from the owner and other related businesses. Now, this is going to become extremely important when we think about the different forms of business organization: sole proprietor, partnerships, and corporation. So the economic entity assumption requires that the activity of the entity that you're accounting for must be separate and distinct from the activities of the owner and all other economic entities, related entities. So let's say Mark Zuckerberg decides to purchase 2 automobiles. Do those automobiles go on Facebook's financial records as assets of that company? And the answer would depend on whether or not the assets were acquired by the business for business purposes, or were they acquired for personal use. If they're acquired for personal use, of course, they would not go on the records of the company. Now, the economic entity assumption has a great deal of application when we look at the common forms of businesses. Businesses could be structured as a sole proprietor or a proprietorship. That's where one person forms the business. We could also have a partnership where 2 or more individuals form the business for a profit. So we have a sole proprietorship. And the business could also be a separate legal entity, and that's why I'm emphasizing this, the corporation. Now, you have to remember, when you look at the sole proprietorship, I'm going to get into this in a second, and we look at the partnership, these are not separate legal entities. They are not separate and distinct from the owner. The corporation is a separate legal entity. So that you don't really have to make an assumption about business entity when you think about a corporation. You do have to make that assumption for the sole proprietorship and partnership. So to make this very simple, and here's the key point, From our perspective in accounting, it doesn't really matter what the legal entity looks like. It could be a sole proprietorship, which is not a separate legal entity. It could be a partnership, which is not a separate legal entity. Or it could be a corporation, which is a separate legal entity. We still treat all of them as if they're separate accounting or business entities. And again, only the corporation is a separate legal entity. Now, let's look at the details. Sole proprietor or proprietorship. The business is owned by one person, and the key is that it is not a separate legal entity. It is limited in its life to the life of the owner. The next point is critical. There is unlimited liability for the debts of the business. Why? It's not a separate entity. So if you have your own consulting practice, let's say you're a financial advisor, or you start your own marketing company, and someone sues you for fraud or maybe not satisfying the terms of the contract, they're suing you and the business at the same time. There's no separate business. You can't say, well, you're suing the business, I'm not responsible. So you're personally liable for the debts of the business. However, we still account for it as if it's a separate entity, because we invoke the economic entity assumption, even though it is not a separate legal entity. Okay. We go to the whiteboard. And if you look at the sole proprietorship, from a legal standpoint, the owner, let me clean that up for you a little bit. And the business are a single entity. So that means that the debt are one and the same. So if you say that you have a business automobile and you put the business in the name of you put the auto in the name of the business, a car loan in the name of the business, you're still responsible as an owner. There's only one tax return. In most cases. So that the business income gets added to the personal income. So there's only one tax return. Business is not taxed separately. Now, accounting separate entity. We have the owner, the individual, and the business. We would account for the business separately. We would not include any personal transactions. So, for example, if the owner buys a home, even though it's one and the same legally, right? So legally it's one and the same. For accounting, the home is not an asset for the business. If the business buys a piece of equipment, we treat it as a separate business asset. Here, of course, legally, the sole proprietor would in fact have a single balance sheet. So that would be an asset of both the owner and that would be an asset of the business from a legal perspective. Partnership. General partnership is a business owned by two or more persons that are partners, and of course they go into business for the purpose of earning a profit. This is not, again, not a separate legal entity. Once again, it's limited life, and in most cases, there's unlimited liability, and there's also something called mutual agency, which means that if one of the partners transacts for or in the name of the partnership, the other partner is also liable. So that mutual agency means that if one of your partners borrows for the business, you are also responsible for those debts. Of course, once again, we invoke the economic entity assumption. It's economic substance over legal form, once again, that we treat it as if it is a separate entity. Now, there are limited liability partnerships where personal assets could be partially protected, but we're going to look at the general partnership. Now, let's take a look at the general partnership. Back to the whiteboard. So if we take the general partnership, so once again, from the legal perspective, you're going to have the partners, say there's two of them, and the business. There's no separate entity from a legal perspective. Now, there is an information tax return. The business is not taxed, but the income flows through to the partners. And that's why it's sometimes called a flow-through entity for tax purposes. So any income here is distributed to the two partners. Now, from an accounting perspective, the business is separate from the partners. And again, whether there's debt, whether there's assets being purchased. So if one of the partners buys a car or signs a contract for a vehicle for business use, let's say it's a truck, even though it's owned by this particular partner, if it's used for the business, it goes on to the business accounts. So the general partnership, we have to make, once again, you have to make the entity assumption. So this is basically the entity assumption here. And you also have to make that assumption for the sole proprietorship. Finally, the corporation. Corporation is a separate legal entity, and this is the key. Corporation is a separate legal entity so that it is not going to be subject to the same problems that we had with the sole proprietorship and the partnership. So it's incorporated by the state. Ownership is divided into shares of stock. Shares of stock is sold to investors, and then you have, of course, multiple owners, right? So you have multiple owners. And obviously hundreds of thousands of owners if they own the shares of stock. It is a separate legal entity, and it is separate and distinct from the shareholders. It is a separate legal person. And therefore, the corporation could borrow money in its own name. it can incur debt in its own name, and the shareholders are not responsible, unless, of course, there was something done by a shareholder that may be fraudulent or may violate a contract. However, you could have a manager, by the way, someone works in the company that owns stock. So I'm sure that, Mark Zuckerberg owns stock of Facebook, or Steve Jobs might have owned some stock of Apple. I think Bill Gates just got rid of all of his Microsoft stock, but while he was there, he was working, so he was a shareholder. So technically, I guess he could be sued as an officer of the company. But if you're just a stockholder, so if I own Apple stock right now and something is done in terms of a patent infringement, any losses on that patent infringement, let's say with Samsung for an Android, would not affect me as an individual. So the corporation is a separate legal person. They can borrow money in their own name. They can incur debt in their own name. It is, in fact, not going to be necessary for us to invoke the entity concept. So when we look at a corporation, and back to the whiteboard, the business and the owners, which we call shareholders or stockholders, are separate and distinct. So this is for a legal, it's a separate legal entity, and it's a separate accounting entity. And the business entity concept is not required here. We don't need to invoke the business entity concept because it is a separate entity. Now, some of the advantages of a corporation, well, it has indefinite or continuous life. You just simply transfer ownership by shares of stock. There's limited liability, no mutual agency. So again, you're not responsible for any action taken by Apple if you're an Apple shareholder. You're also not responsible for any action taken by another Apple shareholder, so there's no mutual agency. And again, as I said, the economic entity assumption is not necessary for a corporation. So far, when we, again, we're talking about organizations that issue or promulgate accounting standards, so the FASB, etc. Now we're also looking at the underlying conceptual framework. We said the primary objective of financial accounting is to provide information to enable users to make rational economic decisions. Information is useful if it's relevant and faithfully represents the underlying economic substance of the transaction that it purports to represent. And now we're looking at some of the assumptions. So the first assumption was economic entity. The next assumption or principle that's part of the conceptual framework is the historical cost concept. Assets, liabilities are recorded at their actual cost on the date of acquisition, and it remains at cost for the most part. There are some, uses of market value, but it remains at cost until it's sold or used in operations. You could say, and by the way, cost is also often called historical. Historical cost. And cost is the agreed upon acquisition price that results from an objective or a bargain transaction. A bargain transaction is where both parties are attempting to get the most benefit out of the transaction, or you're trying to maximize your own wealth. Asset and liabilities continue at cost, as we said, unless they're reduced by usage. And again, usage for, let's say, a plant asset or a car would be something that you probably heard of. Depreciation. We do not. We have some exceptions. Some securities are valued at fair value, but under U.S. GAAP, with some exceptions, we do not adjust anything on our balance sheet, the carrying and reporting value, at fair value. And this is based on conservatism. And also based on conservatism, if an asset value is impaired, it will be written down to market. So in other words, you can't carry an asset above what it is worth or above its value. So let's go to the whiteboard again. And we have to think about a couple of things about historical cost as well. But if we set up some boundaries, for the most part, under U.S. GAAP, there are some exceptions. Let's just take an asset, for example. Cost is the ceiling on asset valuation. In the event that, for example, you own a building, that building is in an area where, let's say, the economy is starting to decline and you have to charge rent that is significantly lower than you used to charge in the past, that means the value of that building has declined. So that asset has been impaired, and we write it down to a market value or fair value. Now, and by the way, when you have an impairment, that's a loss of asset value. When you write this asset down to market value, I just said a few minutes ago, we don't value them at market. But what we don't typically do is the following. We don't typically value them above cost. So let's say that building is in an area now that has substantial economic boom. The economy is growing and the rents are tripling. That means the fair value of that real estate is much higher. We do not reflect that real estate at a higher value than its original cost. Now, there are exceptions under international standards, and there are exceptions when we look at things such as investment securities, but we do not necessarily, probably will not see this for a while, but we don't write under U.S. GAAP, we don't write these up above original cost. Now, the question, if you go back and let's think about this a little bit more in terms of our conceptual framework, and thinking again about that conceptual framework, going back to the usefulness of reported information, relevance, and faithful representation. So if we look at historical cost means that if you bought this building, for $3 million in 2012, that is something that you could verify. It is something that I can faithfully represent by looking at the mortgage. I can look at the information that's provided by legal documents that you're the owner of this building. So it would be faithfully represented or would have faithful representation. However, what if, as I said, the economy picks up and that building is now worth $5.5 million? Is historical cost relevant? Well, the fact that we don't use the market value means that historical cost is going to provide us with a faithful representation, but it is less relevant. than fair value. And sometimes you'll see that trade-off. So that in lots of cases in accounting, we have to decide whether or not we're going to trade off relevance for faithful representation. And you'll see that throughout the course in many cases. The next assumption is known as the going concern concept or going concern assumption. Now, under the going concern assumption, we state that the business will remain in operations for an indefinite, not an infinite, but an indefinite period of time. And this is really the amount of time that the company is going to need to carry out its contemplated operations, liquidate its existing obligations, and provide an expected return to its owners. Now, when we think about the going concern concept, this is essential if we're going to ask the business or we expect the business to engage in long-term agreements. For example, it might not make sense for a business to acquire an asset that is going to be long-term if the expectation is that the business will discontinue at a very short or in a very short period of time. So a manufacturing company would not enter into a long-term sales agreement if it believed that the customer would be out of business at a very short period or in a very short period of time. So we basically invoke this assumption when we buy a durable good. So if we buy a building, if we buy a car, for example, we are making a going concern assumption, because if we buy a car that gives you, for example, I believe a Hyundai gives you a 10-year warranty, you're going to assume that the business will be in operation long enough to cover that warranty. You know, during the bankruptcy of General Motors, during the recession, the 2008 recession, during that period of time when General Motors was bankrupt, the question becomes whether or not you're going to purchase a vehicle from GM. If you think they're going to be going out of business, will they be able to cover their warranty? The same is true today for BlackBerry. If you're buying a BlackBerry phone, the question then becomes, will BlackBerry be in business long enough to cover their warranty? So the same thing's true in accounting. We make an assumption that the business will be in operation long enough to carry out its contemplated operations, discharge its existing or pay off its existing obligations, and existing obligations include these long-term warranties that I just mentioned, as well as to provide a return for its stockholders. Now, an application of the going concern is something we see in financial reporting. When you look at a financial report, you're going to see assets, and some of them are going to be listed as long-term assets expected to be in operation for more than a year. Short-term assets are assets that we expect to be in operation for a period of 1 year or less. The same thing is true with liabilities. You have long-term liabilities. These are liabilities that we expect to pay off in a period greater than 1 year, maybe a 15-year mortgage or a 3-year car loan, or a liability that is current. You know, a credit card bill that you have is due in 30 days. Businesses have the same types of open lines of credit. We also use the assumption to justify depreciating a building for a 40-year period. So the going concern assumption is applied very often in the financial statements with respect to classification of assets and liabilities, as well as the operations that we use to value, or the methods that we use to value assets, such as depreciation. We also have the monetary unit assumption, and this is fairly, common sense type information, where we recognize transactions that are recorded in terms of a monetary unit, and in the United States, that's the dollar. We continue to use the dollar as the unit of measurement, even when the underlying value of the currency changes, so there's inflation. Now, we don't adjust for inflation in the United States, but in some countries, there is inflation accounting. So we basically are saying that there is no inflation, and this means that we add on the balance sheet, we add dollars of different purchasing power. So, for example, if we add a land that we just bought, let's say in 2013, to land that we purchased in 1963, we are actually applying the business entity assumption. Again, if you think about this, it may not make too much sense, but we do ignore inflation. So remember, we said that the land that was bought in 1963, under US GAAP, we don't write this up to fair value. And remember, we said that this is a faithful representation, because if you paid in 1963, let's say you paid $1 million for that land, today it could be worth hundreds of millions of dollars, but that is a faithful representation, although it is not very relevant. You buy land today in 2013, well, let's say you buy it in 2013, last year, then it could be something like $17 million. So we add that on the balance sheet and we say our land is worth $18 million. So we essentially ignore fair value, is ignored, and inflation. Is also ignored under the monetary unit assumption, as well as going concern. You can see that these assumptions are sort of related. If you think about it, we assume stable purchasing power here. We assume stable purchasing power by ignoring inflation, but again, that assumption is made by adding dollars of different purchasing. I mean, clearly, 63 and 2013 dollars are of different purchasing power, but again, it is based on other principles. So you might say, okay, we're invoking the monetary unit assumption, and what is another assumption that supports that? The historical cost concept clearly supports monetary unit assumption. And although it is less relevant, it is more reliable or faithfully representing the numbers. So once again, I can go back to 1963 and get a mortgage and other legal documents that will prove that the company paid $1 million for that land. However, if I went out right now and I got an appraisal, so let's say I get an appraisal value and say this land is really worth, something like 21 million. That is an estimate. That's a real estate appraisal. So that appraisal is going to be given to us by someone that is an expert in the field. However, what happens next year? That 21 million could be valued at 23 million, or it could be 19 million. So it fluctuates, and although it's more relevant, it is not going to be a faithful representation, because perhaps the appraisal is not objective, and perhaps the appraisal is not accurate. So that's one of the reasons why we do not use fair value accounting for plant assets or land and buildings in the United States. Now, another part of the monetary unit assumption, it limits what we record on the balance sheet. We can only record assets and liabilities on the balance sheet if we can measure them in dollars. So, for example, there can be intangible assets that are not sold. There's no market. For example, right now, the valuable brand name by Nike, that cannot be valued because we don't have a market for it in the financial statements, or we don't have a market for it outside of the company. We just don't know how much it's worth. Since we can't measure it objectively, we do not put it on our financial statements. So again, going back to the whiteboard, there are lots and lots of assets that we valued, but we cannot put a dollar amount on them. And again, it's limited by the monetary unit assumption. Cannot record on the balance sheet what we cannot measure in terms of dollars. So we mentioned a logo, like the Nike logo, the swoosh. Again, there's no cost that we can reliably use to measure that brand name. And that is true for lots and many other, what we would think of as intangibles. That we really can't measure. So, for example, unless someone buys it, of course. So, unless purchased, by another entity, we cannot measure human capital. And these are intangibles in other let me just correct that. Other assets that cannot be really cannot be measured in dollars, but what we're really saying is here we cannot reliably value them. So human capital is one. Another would be something like, again, certain brand names. Three could be a location. Superior location for your business. Okay, again, we cannot measure these unless it's purchased. So if someone buys your company, they may pay you a premium for your workforce. Or if somebody buys Nike, they'll pay them for the swoosh or the logo. If someone buys your company, they're willing to pay a premium for that location. Sometimes all of this is wrapped up in what we call goodwill. And, we'll see this as we move along. But again, this is considered part of that monetary unit assumption. So again, if it cannot be cannot measure it reliably in dollars, it is not required.